inflation line, much as it was the most volatile return series over the period when we looked earlier, is the most conservative or stable when you consider the funding level or you're measuring the liability as provision of that income. So this has implications for our life stage framework, because today the life stage framework allocates a large amount to a fixed income component. A lot of the time it's nominal bonds, sometimes close to retirement it's cash. Well, the implication is either we're focusing on the fund credit, which we do, or we're targeting a level annuity in retirement, which I'm sure we're not, because inflation is the silent assassin, but that is the implication of it featuring so prominently in our framework today. Another aspect that's missing from how we devise our investment strategies is this notion of human capital. Now, human capital is probably the most important asset or the most significant asset that people will have for the majority of their working lifetime. Human capital is the future contributions you will make towards your retirement provision. An individual joining the fund in their 20s has almost no fund credit, but significant human capital. And in fact, whilst Life Stage may come up with the proposition that we should have high equity when you're young, and a small fixed income component, and another strategy that we may talk about also does, the reason is because of the human capital component. Because it is such a huge part of your strategy, you can afford to take the risk. Not necessarily because we have a long time for our member to recover from any negatives that may come from equities. So looking at our balance sheet, rather than looking at it, as we do today, as actuaries, that assets are equal to liabilities for our DC members, what we could do is have a look and say, our asset is our fund credit, our liability is the required income in retirement, but we cannot ignore the human capital component either, because it is a significant asset, and if we ignore it, we will come up with a suboptimal answer. So now, going back to the example of Lindiwe and providing the right information, instead of showing her that she had R1 million in fund credit, what we can do is show her that the accumulated savings thus far will provide her 6,100 Rand of inflation-linked income in retirement, or at least expected to, and that her future contributions are expected to generate another 1,100 Rand per month. So all in all, she's on track for 7,200 Rand of inflation-linked income. The calculations for this can be done by actuaries. They're transparent, they're objective. In this example, they're market consistent. I haven't assumed a heroic expected return assumption or a particular annuity where I keep the discount rate artificially high. They are market consistent, and so if Lindiwe retired the next year, that is the type of income that she would be able to receive. And so what we've done is we've changed the nature of the statement dramatically from referring to the pot of money to a likely stream of real income. It did not require significant education exercise on the part of the trustees, the fund, or the employer. Lindiwe understands that. So it's important, therefore, that if we've got this liability that we're trying to gear up to, which is income, that trustees set an appropriate income goal. And we will use, or we advocate using the replacement ratio, which is nothing new. That's what we normally are doing in any event. But there are some problems with how this is being done in practice. Sometimes we work out the replacement ratio and it starts off in our investment policy statement well documented, but is there any real feedback to see whether you're on track to achieve it or not? Is it done at a fund level or is it done at an individual level? Do we sometimes look at the expected replacement ratio and then infer some real rate of return that might get us there? So maybe that was done 10 years ago and you got that you needed CPI plus 5. Well, I can tell you that if you did that 10 years ago and worked it out then and got CPI plus 5 each and every year, you would be short of being able to provide that level of income in retirement because it's the wrong benchmark. And so most of you, or all of you, should have got socks from Colourfield in your bags, and in it is a note. It's all about goals-based investing. What good is beating the benchmark if you don't reach your goals? So it's essential that an appropriate replacement ratio is targeted, customized for each individual member. When we say that, we mean that if a member has, if you set a goal of an 80% replacement ratio, assuming 40 years of service, and you have a member in the fund for 20 years, well then potentially that goal for that individual is 40% replacement ratio. I'm not saying that it always has to be pro rata, but we should be making adjustment for the time that the individual actually spends within the fund. So the most common request would be a replacement ratio of 100%. We know from a lot of research that's out there, these are two excellent papers if you ever need to explain to trustees or members why you should be able to provide less than 100% replacement ratio to maintain a standard of living. They're papers by Manel and Soto, who say that 65 to 75% replacement ratio can maintain the lifestyle, or by Seshadri, who says 75% is the optimal replacement ratio. Our own government in 2004 published a discussion paper where they spoke about 75% for individuals. So under the current conditions, we believe that that objective is unlikely to be achieved. There are misconceptions. In our opinion, we believe they said so often this concept of 70 or 75% that they're no different to saying that the Great Wall of China can be seen from space. It cannot. That the fortune cookie was made in China. It wasn't. It's an American invention. Or that we only use 10% of our brain. Neurologists have proved we use 100% of our brain most of the time. And so if you go back to a clean sheet of paper, what is an achievable target? Well, we know the inputs that are required. It's the contribution rate, it's the working lifetime, it's the investment return, and the annuity purchase at retirement. So in terms of contribution rates, those are set by the rules of the fund, and so we can take that as a given. But in terms of looking at what generally we can expect, well, National Treasury says that 10% contribution towards retirement provision can be assumed. That would be terrible. I hope that everybody is aware advising is advising more than 10%. Alexander Forbes' benefit barometer in 2014 showed that most funds, depending on industry, were contributing about 12 to 15.7% towards retirement provision. This is of pensionable salary, so obviously they reduce. From an investment return assumption, this I think is where things have changed quite a bit. We think that the maximum real return assumption that you should be using is around 4.6%, maybe 5%. How do we get that? Well, the average real yield on inflation-linked bonds at the time of writing the paper was 2%. It's come down recently, despite the nominal bonds going up in yield. We assume an equity risk premium of 3%. We add another inflation risk premium of 0.5%, and so the expected return on equities is about 5.5%. We then assume that there's no life staging, that you allocate the max 75% to equities through the term, and that alpha is equal to fees. And if you do that, we get an expected return of 4.6% on the investment portfolio each and every year. The cost of annuity at retirement, as we've said, we think that the least risk choice is the inflation-linked annuity, and so we look at those are being priced at. And so if you contribute to 12.5% for 35 years with a real return of 5%, so we've upped it from the 4.6, you get a replacement ratio expectation of 54%. And if you were to increase that up to 15%, well then it's now 65%. That reduces even further if we take into account the fact that those were pensionable salaries and not necessarily the actual salary. And obviously each fund needs to do this based on their own fund circumstances. So the question is, well, did we get it wrong? Were there big changes? How did we have 70, 75%? Now all of a sudden we're looking at figures of 65 at most generous and probably lower. Well, this is a menu from the Lone Spur. And it's not easy to see, but 55 cents would have bought you a Whiz Burger. And in fact, for the cost of any burger at Spur today, you can buy every single item on this menu from however many years ago. And it's that frame when sometimes you speak to somebody who's framed in the past, who hasn't looked at how things have changed, they say, in my day, it cost this much, or things were that expensive. Although I can't always use that analogy. I keep trying to tell my kids how much movie tickets were, but theirs is free on Discovery, so it's actually gone down. But what has happened is that bond yields have fallen. From the time that Treasury published their paper, we had real yields of around 3.5%. They're now down to 2%. That's a dramatic fall in what you can get risk-free over that period. And they haven't shown any signs of going that much higher than 2%. You've got to look at the market-consistent expectations. And so both the investment return we achieve while we're working and the cost of annuity when we retire has become more expensive. What's also happened is that people are living longer. So when you were in a DB plan and you had a 2% accrual rate, so you were going to work 35 years and get 70% of your salary at the end, well, now you've got a situation that you were working for 35 years to potentially pay for 15 years worth of lifetime when you're retired. But one of the reasons DB funds broke down is because people lived a lot longer than they used to. And so people are living 5 to 10 years longer, and so 35 years worth of savings doesn't pay for 15 years worth of retirement, it's paying for 20 or 25.